Are you concerned with reducing your taxes and achieving financial independence? Most Canadians would share those goals with you. Welcome to my Investment Essentials for Newcomers videos, where I'll give you a few tips to reduce those taxes and help you along the path to achieving financial independence and security. I'm Anna Hilbury. Please like and subscribe to my YouTube channel. So before I launch into the essentials, I want to give you a little bit more information about newcomers to Canada. The following three charts are from the OECD. Did you know that Canada ranks #1 in the OECD for attracting the highest inflow of workforce-ready immigrants? Not only that, but 70% of those immigrants are highly educated. And again, that's #1 in the OECD. Canada ranks 5th in what skilled workers look for most and #1 in what entrepreneurs are looking for. So it's likely that not only did you bring wealth to Canada, but that you're going to continue to build wealth while you're here. You work hard, so why not make your money work hard for you? Let's go through it now. The first account I'm going to talk about is an RRSP, or Registered Retirement Savings Plan. Now, this is a type of account where you can put money in and it'll grow tax-free up until retirement. So let's assume you have $1 in income earned. You can put that dollar into the RSP. It reduces your taxable income by $1. That dollar will grow inside the RRSP tax-free. That means no tax on growth or income earned up until the time of withdrawal. And that has to happen, by the way, when you turn 71 years old. You'll have to convert your RRSP into a RIF account, or Registered Retirement Income Fund. So let's go through an actual example so it makes a little bit more sense, because it's just sort of hard to conceptualize unless you see the actual dollars. I wanted to bring up an example of a married couple. Spouse number 1 has income of $120,000. On that income, they'll have to pay federal and provincial tax of about $33,000. That's a big tax bill. Now assume they want to set aside $10,000 in the form of savings through an RSP contribution. That will reduce their taxes owing from $33,000 down to $29,000, because it reduces their taxable income from $120,000 down to $110,000. That's a total savings in their pocket of about $3,900, so a pretty good deal. Now let's look at spouse number 2. Assume that spouse number 2 has to stay home, maybe to raise the kids and look after the house. Not an uncommon situation. So the income is reduced. This person is only making about $30,000. Now on that $30,000, they have to pay tax of about $4,700. Assume this person wants to make $10,000 RSP contribution as well. Let's look at how it impacts their income and their tax savings. It would reduce their income from $30,000 down to $20,000 for taxable income purposes. It reduces their taxes payable from $4,700 down to $2,700. So it definitely reduces their taxes. Savings are about $2,000. But if we compare that to the higher income earning spouse, the difference is about $1,900. So you're way better off to put the savings towards the person who has the higher level of income, because as you can see in this example, you get a lot more money back at the end of the day. Let's look at another example. How much can you save each year in an RSP? You can save the lower of 18% up to a maximum of $27,000. So let's take an example so we'll make it a little bit easier. Let's assume Raj has just moved to Canada. She's a new immigrant. She's earning about $40,000 a year. She can save 18% of that, accrues each and every year, for a total of $7,200. Now let's assume we fast forward a couple years. She's got her new business. Things are going very well for her, and she's earning around $150,000. She can put aside, again, about 18% or about $27,000. So you can see up to a maximum of about $150,000, you can set aside about 18% of your income, and over that, you can't really set aside more money. But there are other accounts that you can open that you can save money, and I'm going to cover those next. So let's look at those now. TFSA, or tax-free savings account. A tax-free savings account is yet another way to reduce tax, and it has nothing to do with how much money you make or how old you are. As long as you have a social insurance number that's valid and you're over the age of 18, amounts will accrue each and every year. You can be retired and still have TFSA room that comes up each and every year. So let's bring up a graph showing the various amounts that you can save over the years. It does become a little bit convoluted, so it is important to look at which year you arrived in Canada and then go ahead and look at each year. As you can see, it's varied from $5,000 to $10,000, and in 2019, we're at $6,000 each and every year. So the total cumulative amount that you can save if you were here at the beginning of the period, so from 2009, is about $69,500. Now, unlike an RSP, a tax-free savings account is after-tax dollars that you're putting inside. So you already paid the taxes on those monies, and it doesn't reduce your income. So let's assume you put $5,000 into a tax-free savings account. It doesn't reduce your income by $5,000. But what happens is, while those dollars are inside the tax-free savings account, much like the name or title of the account, there's no taxes paid, with the exception of US dividends. Everything else, there's no taxes paid. Canadian dividends, interest income, capital gains, that sort of thing, no taxes. It's a great deal. And unlike an RSP, where when you take the money out, that room is gone, you can't put that money back in again. A TFSA, let's say you put $5,000 in year one, and in year two, you decided you need the $5,000 back, you would just have to wait another year, and then you can go ahead and recontribute that money back into the TFSA. So they're more flexible, and they're a really great way to reduce taxes. Now let's talk about saving for your child's education and how you can reduce taxes and get a little bit of a boost on income earned there. RESP, or Registered Education Savings Plan. Much like the TFSA, it is after-tax dollars that you're putting into the RESP. So you don't get a tax reduction on income tax payable to the government or to CRA. You put the money into the RESP, and you get matching grant from the government of 20%, up to $500 maximum in any 1 year. There's a total lifetime maximum grant that you can get in the form of Canadian Education Savings Grants of $7,200, so it's a pretty darn good deal. And while the monies are in there, they grow tax-free. When they're taken out, they're added to the income of the beneficiary or the person who is receiving it. So it'd be your child when they're going to school. And as everybody knows, when you go to school, generally you don't make very much income. And so there'll be almost no tax paid. So again, it is another great deal you definitely should take advantage of. If you want more details, you can check out my previous video that I made on RESPs. Now that we have a basic understanding of the three different types of accounts where we can reduce our taxes payable to CRA, let's look at what kind of investments, the basic type of investments that you can hold inside each of these. There are 4 basic types of investments that you can put inside an RRSP, a TFSA, and an RESP. There's definitely more types of investments allowed out there, but these are the 4 basic ones. So the first one is a GIC, or Guaranteed Investment Certificate. These are not cashable, and they do not fluctuate in price. Number 2, a bond. A bond is sellable when you buy it, although you may run into liquidity restraints, and by that I mean ability to sell it and have a buyer buy it from you. They do fluctuate also in price. Number 3 is a stock. Stock represents an underlying ownership of a company. They definitely fluctuate in price, but there's opportunity for growth. And number 4 is a mutual fund. A mutual fund could be a basket of bonds. It could also be a basket of stocks, or it could be a combination between a basket of bonds and a basket of stocks. These are a pooled investment vehicle, and it is unitized. So each unit would represent a portion of the underlying portfolio. Those are the 4 basic types: GICs, bonds, stocks, and mutual funds. I'm Anna Hilbray. I hope this has been helpful for you. Thank you so much for listening.